Okay, everybody. First, I think last week I couldn't convert the audio and video to the YouTube channel. So even though I sent an email through BYS, I have to tell the midterms were between 2nd and 4th of June through UZEM system. I will ask the questions on the midterms on the 2nd of June, and on the 4th of June at 17 o'clock, I will also send the questions to the BYS system. Between those 2 days, you will have to download the material, your online submitted papers, to the distance learning system. You can see our class, International Political Economy, over there also. And finals are between 29 June and 2nd of July. So in those days that we have in the class, these 3 days, you will have a 72 hours again. On the 5 o'clock evening of the 2nd of July, your final papers should be submitted by you to this distance learning system. And for Erasmus students, sometimes if you have a problem with the downloading or uploading these documents to the system, you may actually prefer to send it to me through email. But it is just for Erasmus students. I think for Turkish students, there shouldn't be too much problem to upload or download documents to the distance learning system, because I checked and you guys have student records in the distance learning system. So you can, when you click on the International Political Economy to PISR 2052, you can actually upload your documents and see these midterm and final questions over the system. So this is the first midterms and finals. And as I said last week, you have to be very careful in terms of not to copy paste other people's work from internet, or if we catch from when we check the documents, and if the system diagnosed that the system diagnose any kind of cheating on your part, or if you imitate your friends' homeworks or friends' midterms, so there will be problem in terms of those kind of behavior. So don't cheat in these kind of exams and submit your papers through online. And these are essay type questions, and those 3 chapters 6, 7, and 8. Since we couldn't finish these chapters very well, but in this online learning environment, I tried to finish these 3 chapters. So You guys will be responsible for these chapters in midterms and finals. So if you study these 3 chapters from the textbook, Williams and O'Brien's book, Global Political Economy, and if you guys also check my YouTube videos and the recordings of all those 5-6 weeks, you can have a plenty of idea to write and answer those essay type questions that we will ask in the midterms and finals. And there will be some kind of an makeup exam period after 6th of July. That is from 6th of July to 12th of July. Generally, there will be less time for makeup exams. So don't leave these kind of exams to the makeups, because makeups will be much more difficult. You will have only 1 day or 24 hours to answer makeup questions. So try to finish your responsibilities for midterms and finals on time. So next week, even though I couldn't convert the video into YouTube, last week we talked about the financial innovation. Only 1 student actually watched the live broadcast at the time. And as far as I know, we talked about the euro currency market starting from London, how 1970s and globalization in telecommunication and transportation and globalization in electronic fund trading, for example, create new financial instruments like derivatives, futures, and options, and emergence of new financial players in the international financial system. For example, the sovereign wealth funds emerged in markets like the United Arab Emirates, Kuwait, the Singapore, Russia, Norway, China, for example. Most of these countries who generally use their trade surpluses in these sovereign wealth funds, for example, they started to influence the international financial system and international banking system or in international trade. And most of these countries generally sell their raw materials or domestic resources, mines, oil, natural gas, and they got some kind of a wealth, and they actually invest those sources of wealth into these wealth funds. So most of the time, if you open up a wealth fund in the international financial system or in your country, you need to have some kind of an actually excess surplus to invest in different areas in the international financial system. So today, if we continue from where we left, another financial innovation in the system was emergence of hedge funds in the system. So what is this aggressive style financial investments? In financial markets, pardon. These aggressive style investments in financial markets, these hedge funds, for example, generally they are much more limited in terms of who can invest these hedge funds. For example, if you don't have enough money, let's say less than $1 million or $500,000, more than likely you cannot invest in these hedge funds. They're actually somewhat choosing an elite group of people who are actually really rich, for example, millionaires, to manage their money. So on the behalf of these rich people or elite groups, these hedge fund managers, for example, aggressively evaluate the conditions of the financial markets, and then they invest this money in different operations in financial markets. Why we call it much more aggressive? Because they not only take the risks of, for example, markets going up, but they also put their investments or put their money when the markets are losing value or the values in markets are decreasing, for example, in stock exchange or bond markets. So they generally aggressively evaluate the conditions of forward and options markets in international financial system. So because of this aggressive style of their approach, the hedge funds generally get much more in return to their rich elite investors. So as I said, there will be some kind of a commission for these hedge funds. And there are also tax incentives, and in terms of financial operations, because of the money that they manage, almost trillions of dollars, these hedge funds had an advantage in international financial markets and in banking operations compared to individual investors. So this can be evaluated as some kind of a privilege in international financial markets to get into these hedge fund operations or invest your money in hedge funds. And these hedge funds generally, in their market operations, they generally using this leverage in terms of future bets in forward and options markets. What is this using of leverage? This means, for example, when you put, let's say, $1 million, actually you bet on a $10 million value, or $10 million, or maybe $100 million if your leverage is 100 to 1. So according to that leverage, for example, you can multiply your gains and also your losses in this system. So this using of leverage, generally, if you are on the winning side, it can aggressively increase your earnings from financial operations, but it also increases the risk when you are on the losing side. So, for example, when you are losing some money in that kind of using of leverage for $1 million, for example, if we give an example from that number, for example, under normal conditions, if you just lost 10% in the stock or bond markets, more than likely for $1 million, you will have a $900,000 because you lose 10% of your value. But if you use, for example, 1 to 10 leverage, even though you lose 10%, your leverage is 10 multiplies the 10%. That means you almost lose all your money. So that can be very risky investment in itself, and why generally we call these kind of hedge funds as aggressive investors. So not everyone can take these kind of risks, especially if you think about the individual investors in international financial system. These hedge funds, one of their advantage is they're distant from regulations, and they're generally located in offshore business centers and what they call tax havens. And these kind of hedge funds, for example, tended to pay less taxes. So when they manage your money in these offshore centers, we can say they pay less taxes and they are subject to less government regulations because of they have no physical and tangible activity in the territory of, for example, strong governments. So these Caribbean islands, offshore centers, for example, are perfect places for these branches of these financial operators or these hedge funds. So that gives extra profits and yes, extra maneuvering field to these hedge funds and their investors. Because of this, for example, it can be preferred by the rich elite compared to other investment funds or mutual funds. As I wrote, they tended to have much higher returns comparatively, especially, for example, when you think about their performance against mutual funds. For example, mutual funds are much more simple when they generally either invest on stocks or government bonds, but they couldn't have that much involvement in futures and options markets like these hedge funds. So when you look at the annual returns of these hedge funds, they tended to be much higher comparatively to the mutual funds. In this international financial system, another issue is 1980s oil crisis. And debt crisis. If you remember 2 chapters before, we talked about this in international development and international production and trade. If you remember what we talked about in the 1970s, this time we look at the details of this debt crisis in terms of how it was affected by international financial system. In the 1973, the OPEC oil money that was actually given to these international financial operators or Western banks by the Arab governments and OPEC oil producers. Generally, this money of OPEC ended up in the financial investment portfolios of these Western banks. And there are generally the interest rates, especially the interest rates in US dollar, is comparatively lower in the early 1970s. But most of this money end up in Eastern Europe and underdeveloped countries' development projects. And these Western financial institutions transport this money through lower interest rates to these developing countries. And for example, in the short term, these developing countries try to profit from these investments. But development efforts, or you can say the development needs, are generally long-term problems. So the returns of these developing countries' short-term investments couldn't bring that much money or foreign currency to repay those debts from the early 1970s. And most of the system actually recycling of the debt continues when these oil-rich nations, like the OPEC nations, when they transfer these funds to the international financial operations. So in the 1980s, when the oil prices struck and when the oil prices started to decrease, after the 1980s, that means there is no longer this oil money available for investments and recycling of this debt. And another negative issue about these 1980s oil crisis was the United States increased its interest rates in order to deal and tackle with the domestic inflation in the United States. United States, for example, increased the interest rates of United States dollar almost 20% in annual basis. So this means a huge burden in terms of recycling and repayment of these debts in international financial system. So first, the oil money dried up from the OPEC countries because of the collapse of the oil prices. And the second issue is United States increased its dollars. So as a result, what we saw is generally after the 1980s, especially after 1982 Mexican default, the first country was Mexico. Mexico decided to declare a moratorium on its foreign debt because they said they couldn't repay the earlier debts and they couldn't recycle these debts. That means they need to declare a bankruptcy or moratorium in foreign debt payments. So most of the Western countries, G7, IMF, they all were aware of this situation and they tried to prevent a broad scale or widespread international financial crisis through these kind of non-repayment problems. And after Mexico, they, for example, tried to isolate this Mexican case and tried to somewhat restructure these developing country debts. So most of these underdeveloped countries, as we discussed in this class, they started to apply for IMF structural adjustment policies, which also caused a lost decade, for example, in Latin America, what they called in political economy. For example, those austerity policies, especially cutting of social welfare and social spending by these governments under IMF conditions of structural adjustment policies, were pretty much somewhat stamped its effects on the 1980s. So IMF and World Bank became a major household names in the 1980s in the developing or underdeveloped world because most of these countries generally get only help from these two institutions because they tended to bring or give comparatively lower interest rates debt or lower interest rate loans to these third world countries. For example, under normal conditions in international financial system, you have to pay at that time in the early 1980s more than 20% for US dollar foreign credits, but for IMF and World Bank, they can pretty much lower those US dollar interest rates when they actually give loans to the member countries from IMF and World Bank quota. But as I said, they have certain conditions and following up procedures before they give up these kind of installments of loans to the third world countries. So this is some kind of a short run summary of the 1980s debt crisis. But neoliberalism and hegemonic ideology of Washington Consensus and IMF and World Bank, trade liberalization, privatizations, cutting of social welfare, and reducing social welfare state across the world, all these kind of ideological and political consequences generally came with these 1980s debt crisis. They helped the spread of the hegemonic ideology of neoliberalism in the 1980s. So if we look at the key issues in the 80s and 90s in international financial system, creation of euro as a single currency and creation of eurozone. After 1st of January 2002, that was, for example, creation of the European Union single currency. And at that time, for example, European Union became some kind of a third most important economic actor by getting into this euro currency, or as a single currency, euro, as a result of this unification, financial unification of European banks and European central banks. So they actually created this European Central Bank in Frankfurt as German economy as the center of this European Union. And with the help of French, Italian, Dutch, Belgium, and other authorities, they created a coordinated Eurozone economy. They actually target to comparatively get some kind of a comparative advantage against the United States and Japanese economies after the 1990s. So this creation of the Eurozone and creation of the euro currency as a single currency of European Union were generally results of these policies from the 1990s. 12 members of the EU first joined this Eurozone after 2000, even though, for example, after 2010 with the Greek government, for example, lied in terms of their activities. They lied to the EU authorities about the economic indicators of the Eurozone criteria and how Greek economy was doing in terms of all those criteria, but they actually changed the numbers and somewhat manipulated the Eurozone authorities. So 11 members plus Greece actually joined the Eurozone, but after 2010 in Greek financial crisis, we saw that retrospectively Greece as a government somewhat manipulated those numbers. For example, those common standards of the Eurozone criteria was generally first your public debt not surpass 60% of your gross domestic product. It is one of the most important Eurozone criteria. The public debt means government debt, actually. The government debt shouldn't surpass, when you actually put it in proportion to the gross domestic product in an annual year. If it surpasses 60% of the gross domestic product, then that European country couldn't satisfy that Eurozone criteria. For example, in order to get into European Union and Eurozone, especially Eurozone, and started to use single currency of euro, you have to comply with this public debt criteria. There should be a relatively lower inflation numbers. That means, for example, when these countries have declared their annual inflation numbers, they should have some kind of a standard inflation, and they should reduce those inflationary numbers around 2-3% a year. They should be very close to the German inflation number because it was the strongest country in the Eurozone. So that relatively lower inflation criteria was another stronger expectations of the Eurozone from the member states. So in order to standardize the economy and trade relationships across the Eurozone region, these countries should have a standard purchasing power and standard inflation. If your country have relatively higher inflation, that equally affects the purchasing power of your population. And budget deficits of the countries, another criteria of the Eurozone. It cannot surpass the 3% of the gross domestic product of that country. If your budget deficit in terms of this at the end of the fiscal year, if your government's revenues are generally less than the expenditures, you have a government budget deficit. But in order to satisfy this Eurozone criteria, it shouldn't surpass 3% of your gross domestic product. It is also some kind of an relatively harmonization of Eurozone economies, and these Maastricht criteria from the 1990s are generally chosen as guidelines to actually give some kind of an information or a roadmap to these Eurozone member countries or to Eurozone candidate countries in the 1990s. And when in 1 January 2002, when some of these countries actually satisfy those criteria, they created this 12-country Eurozone. And afterwards, these Eurozone members increased since 2002. But there are also, after the great financial crisis, there are also like Italy, Spain, and Greek. These governments has also a lot of times difficulties to satisfy, even though they are in Eurozone, they have difficulties to satisfy and continue these Eurozone criteria. And another thing that we can talk about as a key issues in the 80s and 90s is in third world countries, a lot of times because of economic problems, we also see what they called the dollarization of currencies across the third world, like Argentina and some of the other Latin American countries. What is this dollarization of currencies in the third world? It's generally came from the fact that people's loss of faith in their national currency. For example, higher inflationary rates can be an example of this loss of faith in national currency. So people, when they see their national currency loses value across the months or years, they generally prefer to invest their money and convert their money to the US dollars or other reserve currencies in international markets. That loss of faith in national currency not only creates a loss of confidence in the national economy, but it also put pressure in the domestic economy because, for example, in that way, the domestic investments and domestic manufacturing sector has great disadvantages because they started to, for example, compete with other countries in terms of US dollar values. So, for example, comparatively, you lose your cheaper exports or cheap export advantages or cheap labor source advantages if your country go into a dollarization. If majority of your population started to convert their national currency to the US dollar or euro or any kind of global currency. They generally try to facilitate international trade through this dollarization because most of these third world or developing countries need foreign assistance or foreign currency for international payments. So when they try to facilitate this international trade and currency payments, they think, for example, pegging or equalizing the value of your currency to the US dollar or other international reserve currencies can facilitate this all transactions between the international community and your businesses. But that way, they actually wrote their printing money sovereignty to the US authorities, because if your country starts this dollarization process, most of the economic activity and economic decision making generally belongs to the US authorities because they have the right to print United States dollars and they generally decide the economic policies related to the US dollar. But when they make these kind of decisions, inadvertently or equally, they also affect your local policies because you have this dollarization of your national currency. So one way or another, we can say you lose your sovereignty in terms of printing money and make sovereign determination of your economic policies by your own central bank. So dollarization can have some advantages, especially in import-export transactions, but it also can have a lot of problems in terms of when the United States government changed its economic policies across the world. So you are under the altar of the US monetary authorities in terms of their decision-making power. So I guess that's it for today's class. As I wrote in here, I tried to convert this video to the YouTube also. So if there is anyone who listened to class, thanks for listening. And we will have a last class next Wednesday on the global financial crisis, and we will finish the semester next Wednesday. As I told you guys 6, 7, and 8 are the